Hello everyone. In this video, we will talk about price to earnings ratio. We will divide our video into the following sections: how to calculate a PE ratio, purpose of a PE ratio, trailing PE, forward PE. We will take an example. We will compare it against a benchmark. In our case, we will use S&P 500, and in the end, we will do a recap. Price to earnings ratio is calculated by dividing the price of a stock by its earnings. For example, the price of a stock is, let's say, $50, and the company is earning $10 per share every year. Therefore, price divided by earnings would be $50 divided by 10 equal to 5. Other way to think about this is it will take you 5 years to recover your investment. Since the earnings belongs to the shareholders, if you made an investment of $50 and you are getting $10 per share in earnings every year, it will take you 5 years to recover your investment. The lower the PE ratio, the attractive the investment is. The purpose of the PE ratio is to understand if a stock is fairly valued, undervalued, or overvalued compared to the general market. Let's say we see a stock with a PE ratio of 5 and the market benchmark is 10. This gives us an indication that our stock is cheaper than the general market. On the other hand, let's say the market benchmark is 3 and our stock's PE ratio is 5. This indicates that our stock is overvalued when compared to the general market. Now that we know how to calculate PE ratio, let's understand trailing PE. If nothing is mentioned with a PE, it generally means trailing PE. Trailing PE, as the name suggests, is calculated by dividing the price of a stock by its last 12 months earnings, or you can also say last 4 quarters earnings. As you can see in this example, the first quarter earnings is $2, second quarter earning is $3, third quarter earning is $4, and fourth quarter earning is $1. If you add them together, you get a total of $10. Now, if you divide the stock price, which is $50, by a total earnings of last 12 months, which is $10, you get a ratio of 5. Forward PE, as the name suggests, is about calculating PE ratio based on the future earnings. Future earnings are not known, so we use estimates. Let's take an example. Let's say we are expecting earnings for next 4 quarters to be $3 per share every quarter, which means $12 per year. So if we divide the stock price $50 by expected future earnings for next 4 quarters, which is $12, we get a ratio of 4.16. This ratio is more relevant than the trailing PE because as an investor, we are more interested in the future than the past. A word of caution here. Our forward PE would be as good as our earnings estimates. If our earnings estimates for next 4 quarters are not correct, our PE ratio would be incorrect as well. Let's take a real-world example and apply the concept we just learned. This screenshot is of Google's stock. It closed at a price of $255.24 on Friday, September 19th, 2025. If we take the non-GAAP earnings for the last 4 quarters, that is $2.12 for Q3 2024, $2.15 for Q4 2024, $2.81 for Q1 2025, $2.31 for Q2 2025, and add them together, we get a total of $9.39. Now, let's divide $255.24 by $9.39. we get a ratio of 27.18, which is what approximately Google search is also showing. So next time you see a PE ratio, you know how it is calculated. There are three important benchmarks in the stock market: Dow Jones Industrial Average, S&P 500, and Nasdaq indices. For this slide, we will use the most famous index, which is S&P 500. S&P 500 is a combination of top 500 companies in the stock market. If we look at the price to earnings ratio of this index, we will get an idea about the general market. If you see the screenshot, current PE of S&P 500 index is in the range of 26 to 30, meaning if you invest $1 in the index today, it will take you 26 to 30 years to get your dollar back as earnings. Now let's compare Google's PE ratio with this benchmark. Google is trading at PE ratio of 27, as we saw in the previous slide. Now, if we compare the two, we can see that Google's valuation is in line with the market valuation. It is neither undervalued nor overvalued compared to the general market. So this is how PE ratio is helpful for us to compare with the general market. Let's do a recap of what we just learned. We learned that PE ratio stands for price to earnings ratio. It is calculated by dividing the price of a stock by last 12 months earnings. The purpose of the PE ratio is to help us understand the valuation of the stock we are considering in comparison with the market benchmarks, whether it is undervalued, fairly valued, or overvalued compared to the general market. Trailing PE is calculated by dividing the price of a stock by past 12 months earnings. Forward PE is calculated by dividing the price of a stock with future 12 months earnings. Since the future is not known, we use estimates to calculate forward earnings. We took Google as a real-world example to apply the concept of PE ratio. We also compared the calculated value with the S&P 500 benchmark to conclude that Google is fairly valued. Hope you found this video helpful. If you like this video, please hit the like button, subscribe, and share. Thank you.